The stock market crash of 2008. The 2008 stock market crash occurred on September 29, 2008. The Dow Jones Industrial Average fell 777.68 points in a day. Until the March 2020 stock market crash at the start of the COVID-19 epidemic, it was the biggest fall in history. The market crashed, in part, because Congress initially rejected the 2008 Emergency Economic Stability Act, known as the Banks Bailout Bill. On October 9, 2007, the Dow reached its pre-recession peak and closed at 14,164.53. The stock market fell by almost 90% during the Great Depression. The table below ranks the 10 largest losses in a single day in the history of the Dow Jones Industrial Average. The Fed began to add liquidity by purchasing subprime mortgages from banks. As the year drew to a close, the Bureau of Economic Analysis, BEA, revised its growth estimate higher. She said the country's gross domestic product grew by 0.5% in the third quarter. At the end of January, the BEA updated its GDP growth estimate in the fourth quarter of 2007 and said growth was only 0.6%. The economy lost 17,000 jobs, the first time since 2004 the Dow has shaken off the news and ranged from 12,000 to 13,000 by March. On March 17, the Federal Reserve intervened to save the failed investment bank, Bear Stearns. The Dow fell to a low of 11,650.44 within a day but seemed to be recovering. The Federal Housing Authority has guaranteed $300 billion in new loans. On Saturday, September 20, 2008, Minister Henry Paulson and Federal Reserve Chairman Ben Bernanke submitted a bill to bail out the bank. The Dow lost 777.68 points during intraday trading. The global markets also panicked. The Ministry of Labor reported that the economy lost 240,000 jobs. On January 2, 2009, the Dow climbed to 9,034.69. Shortly afterwards, President Barack Obama's economic incentive program activated the confidence needed to stop the panic. On July 24, 2009, the Dow reached a higher plane. It closed at 9,093.24, defeating its record in January. In 2013, the stock market finally recovered. Stock prices rose faster than earnings, creating an asset bubble. When did the stock market collapse in 2008? The market decline that included the 2008 crash began a year earlier in October 2007. The 2008 stock market crash was the result of defaults on consolidated mortgage-backed securities. Subprime housing loans accounted for the majority of MBS. Banks offered these loans to almost everyone, even those who did not deserve credit. As the housing market declined, many homeowners retired on their loans. These defaults resonated throughout the financial industry, which has invested heavily in MBS. As a result, companies doing business with these banks were adversely affected, and this brought down their shares, in turn. The scale of the banking crisis has also led to a failure of confidence in the U.S. stock market. As a side effect, the stock market collapsed in the fall of 2008. The U.S. stock market did not recover enough until mid-2013.